Here's something most investors never talk about. While your neighbor is sweating over the latest stock crash, a group of companies has been raising their dividends through every single recession for over 50 years straight. I'm talking about the Dividend Kings, the most elite club of income stocks on the planet. And I've made every mistake with dividend investing, so you don't have to. I chased high yields that got cut. I bought safe stocks that slashed payouts. Today, I'm breaking down my top 5 Dividend King picks that could transform your portfolio into a reliable cash machine for 2025 and beyond. And number 5, that's the ultimate pick, the one stock that perfectly embodies everything dividend investing should be. Stick around for that one. Let's talk about the real nightmare scenario that keeps dividend investors up at night. You do your research. You find a stock paying a juicy 5% yield. You invest your hard-earned money, thinking you've locked in a steady income. Then 3 months later, bam, you get that email. The company has decided to suspend its dividend. I've been there. It's gut-wrenching. Your income vanishes overnight, and your stock usually tanks 20 to 30% in a day. Most people miss the point. A high yield means absolutely nothing if the company can't sustain it. Over the long haul, what matters is reliability and growth. You need companies with fortress balance sheets that can deliver in any market environment. Think about it this way. These companies have survived the stagflation of the 1970s, Black Monday in '87, the dot-com crash, the 2008 financial crisis, and the pandemic. They didn't just survive, they raised their dividends through all of it. That's the kind of track record you want protecting your retirement income. So here's where the data tells a different story than what most gurus preach. A Dividend King is a company that has increased its dividend payout for at least 50 consecutive years. Not 49, not 48. 5 full decades of annual raises, no matter what chaos hit the markets. You've probably heard of dividend aristocrats. Those need 25 years of increases and must be in the S&P 500. The Kings, the bar is twice as high. As of 2025, only about 56 of these companies exist globally. That's it. What's fascinating is that most of these companies operate in what we call defensive sectors: consumer staples, healthcare, and industrials. They sell stuff people need, not stuff people want: toothpaste, soap, and medical devices. When the economy tanks, people still brush their teeth. That's their secret: predictable cash flow that funds those ever-growing dividends. But the textbooks don't tell you that not all Dividend Kings are created equal. Some are overvalued, some have growth challenges, and some are perfect for right now. That's where I come in. I've spent weeks analyzing every single Dividend King to identify 5 specific companies that look compelling for 2025. This isn't just a list, it's a blueprint. And here's the thing. Number 5 on this list, it's what I'm calling the ultimate Dividend King, the one that perfectly embodies everything dividend investing should be. If you only watch one company breakdown today, make it that one. So stick around. For each pick, we'll cover what the business actually does and why it matters, the dividend stats you need to know, whether it's fairly valued today, why it deserves your attention right now. By the end of this, you'll have a concrete action plan to start building your own dividend dynasty. Let's dive into the numbers. First pick, Procter & Gamble, ticker PG. Walk into any American home and you'll find their products: Tide, Crest, Pampers, Gillette, Bounty. This company has been paying dividends for 135 consecutive years and increasing them for 69 years straight. Let that sink in. P&G's competitive advantage is simple but powerful. They own the brands people trust and buy on autopilot. When times get tough, consumers might skip the vacation, but they don't stop washing clothes or brushing teeth. That's recession-proof revenue. Their scale lets them negotiate better deals with retailers and weather raw material inflation better than competitors. They've got pricing power. They can raise prices and customers still buy. The dividend stats. Current yield, around 2.7%. Payout ratio, approximately 60 to 62%. That payout ratio is the sweet spot. Plenty of room for future raises while still rewarding shareholders. Valuation and outlook. As a blue-chip giant, P&G rarely trades at bargain prices. But here's what most investors miss. Paying a fair price for a world-class business beats buying a mediocre company on sale. The company's global footprint and constant innovation keep it ahead. The bottom line is that if you want that cornerstone, sleep-well-at-night stock for your dividend portfolio, P&G is textbook financial fortress material. Next up, Johnson & Johnson, ticker JNJ. This healthcare powerhouse just announced its 63rd consecutive year of dividend increases, making it 63 straight years of raises. J&J operates in two main areas after spinning off its consumer business: innovative medicine and medtech, pharmaceuticals and medical devices. This isn't just diversification, it's diversification within an already defensive sector. Healthcare demand is about as predictable as it gets. People get sick. People need surgery. People want to live longer. That creates multiple revenue streams that protect against any single product failure. The dividend stats. Current yield, around 2.7 to 3.0%. Payout ratio, approximately 53%. That low payout ratio means the dividend is rock solid, with massive room for growth. Valuation and outlook. Here's what's changed. After spinning off Kenvue, their consumer brands, J&J is laser-focused on higher-margin pharmaceuticals and medical devices. This move should accelerate earnings growth. The company is targeting $50 billion in oncology sales by 2030. They're not just maintaining, they're growing aggressively in the right areas. For investors wanting reliable income plus growth potential, all wrapped in a defensive healthcare wrapper, J&J checks every box. Third pick, the Coca-Cola Company, ticker KO. This brand needs zero introduction. For over a century, Coke has been quenching thirsts worldwide. The company sits on 63 years of consecutive dividend increases. Not 64, let's keep the data accurate. Yes, classic Coke is iconic, but here's what most people miss. Coca-Cola's empire includes over 200 brands. Water, juices, coffee, teas, energy drinks. They've adapted. Their business model is brilliant. They produce concentrate syrup and license it to bottlers worldwide. High margins, low overhead, global scale. It's a cash-printing machine that's been refined for over 130 years. The dividend stats. Current yield, typically 2.9 to 3.0%, well above market average. Payout ratio, around 70%. That higher payout ratio might make some nervous, but Coke's cash flows have supported this for decades without breaking a sweat. Valuation and outlook. Coke's brand power creates one of the widest competitive moats in business. You can't just start a beverage company and compete with Coke's distribution network. It's virtually impossible. Growth won't blow your socks off. This isn't a tech stock, but it's steady, predictable, and inflation-resistant. They keep innovating with healthier options while milking their core brands. If you want to own a piece of a global icon that pays you dividends while you sleep, KO is about as proven as it gets. Shifting gears from consumer staples, our fourth pick comes from home improvement. Lowe's Companies, ticker LOW. As one of America's largest home improvement retailers, Lowe's recently crossed the 54-year mark for consecutive dividend increases. That's staying power. Lowe's serves both weekend DIY warriors and professional contractors. While big renovation projects can be cyclical, tied to housing markets and consumer confidence, there's a steady base of maintenance and repair spending that never goes away. Roofs leak, faucets break, paint fades. That creates a reliable revenue floor. The dividend stats. Current yield, around 1.8 to 2%. Lower than others on this list. Payout ratio, approximately 38%. Here's the trade-off. You accept a lower starting yield for explosive dividend growth potential. That 38% payout ratio is incredibly conservative. It signals that Lowe's has the massive capacity to raise dividends aggressively in the coming years. This is a dividend growth machine. Valuation and outlook. Lowe's has been making smart moves, beefing up their online presence, going after professional customers, higher margins, and improving supply chain efficiency. The long-term trend of Americans investing in their homes remains strong. Remote work has made home improvement even more important. For investors willing to sacrifice some current yield for potential massive dividend growth tomorrow, Lowe's adds a different gear to your income portfolio. Think of it as the growth engine among your stable dividend payers. For our final pick, what I'm calling the ultimate selection, we have Colgate-Palmolive, ticker CL. With 62 consecutive years of dividend increases, this company has mastered the art of quiet, consistent compounding. Not flashy, not exciting, just relentlessly profitable. Colgate-Palmolive is a global leader in oral care, personal care, and home care. Their Colgate brand dominates toothpaste markets worldwide. We're talking genuine global leadership. Here's the kicker. A huge portion of their sales comes from emerging markets. As the global middle class expands in Asia, Latin America, and Africa, Colgate is perfectly positioned to grow with them. The dividend stats. Current yield, around 2.6 to 2.7%. Payout ratio, approximately 62%. Safe, sustainable, and room for steady growth. Here's why Colgate-Palmolive earns the ultimate title on this list. It's the perfect embodiment of what dividend investing should be. It's boring, and I mean that as the highest compliment. This isn't a story stock. There's no AI hype, no cryptocurrency angles. Just a simple, time-tested business selling essential products that people buy over and over again, in good times and bad times, in rich countries and emerging markets. You can buy this stock, set up dividend reinvestment, and literally not check it for 5 years. It'll just keep chugging along, printing cash, raising dividends, and compounding your wealth. Over the long haul, boring businesses with pricing power and global reach absolutely crush the flashy stuff. Colgate-Palmolive is that boring business. Now that you've got the blueprint, 5 rock-solid companies, let's talk strategy. The most important word here is diversification. Notice this list isn't 5 toothpaste companies. We've got consumer staples, healthcare, and home improvement, different business models, different revenue drivers, different risk profiles. Don't go all in on one of these. Even financial fortresses aren't immune to industry-specific problems. You want exposure across sectors. Here's your action plan. Start small. You don't need thousands to begin. Many brokerages now offer fractional shares. Use drips. Sign up for dividend reinvestment plans. This automatically uses your dividends to buy more shares. It's the compounding snowball effect in action. Think decades, not months. These aren't get-rich-quick stocks. They're build-wealth steadily stocks. One more thing I wish someone had told me 20 years ago. The best time to buy Dividend Kings is when the market is freaking out about something. When everyone's panicking, these companies go on sale. That's when you back up the truck. Look, building a portfolio that generates reliable cash doesn't have to be complicated or stressful. By focusing on this elite group of Dividend Kings, you're literally investing in businesses that have proven they can thrive through anything the market throws at them. We've covered 5 top-tier companies to start your research. Procter & Gamble, the consumer staples fortress. Johnson & Johnson, healthcare innovation with defensive qualities. Coca-Cola, global brand power with recession resistance. Lowe's, home improvement with dividend growth potential. Colgate-Palmolive, the ultimate boring but profitable compounder. Here's your homework. Pick one of these companies and dig deeper. Read their latest earnings report. Check their investor relations website. Understand what makes them tick. If this guide helped you understand Dividend Kings better, smash that like button and subscribe for more no-nonsense dividend investing content. Drop a comment below. Which Dividend King are you researching first? Or do you already own any of these? I read every comment and love hearing from you. Thanks for watching, and I'll see you in the next one.